Ladies and gentlemen, right now, at this very moment, the ninth most consequential monetary experiment of your lifetime is unfolding, and almost nobody is watching it the right way. They're watching the number. The price of gold, the price of silver, up $1, down $1, a red candle, a green candle. But the number was never the story. The story is what's happening underneath the number, inside a Federal Reserve that just changed its entire operating philosophy for the first time in 14 years. And inside a chairman who has decided that the most powerful thing he can tell markets is nothing at all. By the time most investors understand what's actually happening, the move will already be behind them. That's how it always works. That's how it worked in 1971. That's how it worked in 2008. And I suspect that's how it's working right now. My name doesn't matter as much as the framework I want to give you today, because frameworks outlast news cycles. What I want to do over the next 20 minutes or so is walk you through exactly what Kevin Walsh has done since becoming the 17th chairman of the Federal Reserve, why it matters far more than the headlines suggest, and why gold and silver, two of the oldest monetary assets in human history, are behaving the way they are right now in the middle of 2026 in response to it. I'm not going to tell you what to do with your money. I'm going to tell you what I see, why I see it, and let you draw your own conclusions, because that's the only kind of investing advice that actually holds up over time. Before we go further, I want to know something. In the comments below, tell me where you're watching this from, and tell me honestly, are you currently positioned in gold and silver, or are you sitting mostly in cash right now, waiting to see how this plays out? I ask because the answer says almost as much about the psychology of this moment as anything I'm about to explain. Fear and patience often look identical from the outside. Only time tells them apart. Let's start with what actually happened. In May of 2026, Kevin Walsh was sworn in as the 17th chairman of the Federal Reserve, confirmed by the Senate in one of the most politically divided votes in the central bank's history. He inherited an institution that since the 2008 financial crisis had built its entire communication strategy around a single idea. Tell markets what you're going to do before you do it. Economists call this forward guidance. Ben Bernanke introduced the modern version of it when rates were pinned near zero, and the Fed needed to reassure a terrified world that stability was coming. Since 2012, the Fed has published something called the dot plot every quarter, a chart where each policymaker anonymously marks where they think interest rates should be by year's end. Over time, that chart became almost a promise. Markets stopped pricing in uncertainty and started pricing in the Fed's own forecast of itself. Walsh walked into his first meeting in June and did something that hadn't happened in over a decade. He declined to submit his own dot. Think about what that actually means. The most powerful person in global finance, the one whose opinion moves trillion-dollar bond markets within seconds, looked at the tool everyone uses to read his mind, and he simply refused to use it. His policy statement that followed was roughly a third the length of what markets were used to. Stripped of the usual qualifying language, stripped of hints about the future, built instead around one unadorned sentence: the committee will deliver price stability. No caveats, no conditions, just that. Now, why does this matter to you if you hold gold or silver, or if you're thinking about it? Because markets don't just price economic data. They price certainty and uncertainty as if those were assets in themselves. For 14 years, investors had grown used to a Federal Reserve that told them roughly what tomorrow would look like. Walsh removed that. And when you remove the map, even experienced investors start reaching for the oldest compass in the room, an asset that doesn't need a central bank's permission to hold its value. That's precisely why within days of his most closely watched public remarks, gold moved sharply. First one direction, then another, as traders tried to price in a Fed chairman who had explicitly told them he wasn't going to make their job easy. Let's talk about what the committee itself actually believes, because this is where the real tension lives. At that June meeting, 18 of the 19 participants submitted their rate forecasts. 9 projected at least one more hike before the end of 2026. 8 projected no change at all. 1 projected a cut that is about as close to a dead heat as a policy committee can produce. And it tells you something important. The people who study the American economy for a living, with access to every data series the government produces, cannot agree on which direction the ship is heading. If they can't agree, you shouldn't expect certainty from a headline either. Here is the deeper mechanism, and I want to slow down here because this is the part most retail investors skip past. Gold does not respond primarily to inflation. That surprises people. Gold responds to real interest rates, the rate you earn on a bond, after you subtract expected inflation. When real yields are positive and climbing, holding gold carries what economists call an opportunity cost. because gold pays you nothing, while a treasury bond is paying you a positive inflation-adjusted return. That's exactly why gold struggled through much of the first half of 2026, even as inflation stayed elevated, because the market was pricing in higher rates, and higher rates mean higher real yields. And higher real yields make a zero-yielding metal less attractive by comparison. But the moment that calculus shifts, the moment the market senses the Fed might be done hiking or might even be forced to reverse, gold and silver become extraordinarily sensitive instruments because they are in effect a bet against the durability of positive real returns. This is also where debt enters the picture, and it's the part of the story that rarely gets explained clearly. The United States is currently carrying roughly $39 trillion in federal debt. Every quarter point increase in the federal funds rate doesn't just affect your mortgage or your car loan. It raises the government's own cost of servicing that debt. And it does so on trillions of dollars of rolling short-term obligations. This creates what I'd call a structural tension at the very heart of monetary policy. A central bank fighting inflation wants higher rates. A treasury financing an enormous and growing debt load wants lower ones. Historically, when those two forces pull against each other for long enough, something has to give. And it is rarely the debt that gives first. This is not a conspiracy theory. It is arithmetic. And it is precisely the kind of structural condition that has, across modern financial history, tended to support gold over long stretches of time, because gold does not carry counterparty risk and does not depend on any government's promise to pay. Let me give you some historical context, because none of this is new, even if the specific characters are. In the early 1970s, President Nixon severed the dollar's remaining link to gold, ending the Bretton Woods system. What followed was a decade of double-digit inflation, an oil shock, and a collapse of public confidence in the dollar's purchasing power. Gold, which had been fixed at $35 an ounce for decades, was suddenly free to find its own price. And it found its way to over $800 by January of 1980, an extraordinary multiple of where it started. It took a chairman named Paul Volcker, willing to push interest rates into the high teens and risk a severe recession, to finally break the back of that inflation. The lesson from that period isn't that gold always wins. The lesson is that gold performs best precisely during the years when a central bank's credibility is in question, when markets aren't sure whether policymakers have the will or the room to do what's necessary. Fast forward to 2008. The mechanism was different. A banking system that had over-leveraged itself against mortgage assets nobody fully understood. But the psychological pattern rhymes. When trust in the financial system's plumbing breaks down, capital doesn't wait for permission. It moves toward the assets that don't require anyone's promise to be kept. Gold roughly tripled over the following several years as central banks around the world slashed rates to nearly zero and began buying trillions of dollars in bonds, a policy known as quantitative easing, designed to flood the system with liquidity. That liquidity had to go somewhere. Some of it went into stocks, some of it went into real estate. And a meaningful amount of it went into gold because investors understood correctly that printing your way out of a crisis eventually has consequences for the value of the currency doing the printing. I raised both of those episodes not because I think we're repeating either one exactly. We are not. And I want to be careful never to overstate a parallel, but because they illustrate a pattern in how markets behave when trust in monetary stewardship is genuinely uncertain. That uncertainty is precisely what a chairman like Walsh introduces when he refuses to offer forward guidance. It's not that he's necessarily wrong to do it. There's a real philosophical argument, one he has made publicly, that forward guidance ties the central bank's hands and reduces its flexibility to respond to incoming data. But whatever the merits of that philosophy, the market consequence is the same. Less certainty, more volatility, and historically more demand for assets that don't depend on anyone's guidance at all. Now let's bring silver into this, because silver is not simply gold's smaller cousin. It behaves according to its own logic. And understanding that logic matters enormously if you're deciding between the two. Silver is roughly half industrial metal and half monetary asset. It's used in electronics, in solar panel production, in medical equipment, in a huge and growing range of applications tied to the broader economy. That means silver responds to two different forces simultaneously. The same monetary anxiety that drives gold and industrial demand tied to global growth expectations. This dual nature is why silver tends to be more volatile than gold in both directions. When rate hike fears eased following a weaker Phoenix expected jobs report in the summer of 2026, silver moved by a considerably larger percentage than gold did over the same stretch, sometimes multiple times the move. That's not randomness. That's the higher beta nature of a metal that's pulled by two different economic currents at once. If gold is the anchor, silver is closer to a lever, smaller, but capable of far more dramatic swings when the underlying pressure shifts. I want to talk now about central banks because this is a trend that deserves far more attention than it typically receives from retail commentary. For several years running, central banks around the world, particularly in China, India, and Turkey, have been accumulating gold reserves at a pace not seen since recording began. This is not speculative buying in the way a hedge fund trades. Central banks buy gold as a strategic reserve decision, often over years, and they rarely reverse those positions quickly. Why are they doing it? Partly to diversify away from dollar-denominated assets, partly as a hedge against currency instability in their own economies, and partly, I think this is underappreciated, as a quiet statement about how they view the long-term trajectory of the global reserve currency system. When the People's Bank of China adds to its gold reserves during a month when prices are already elevated, that's not a bargain hunter. That's a long-term strategic actor who believes the metal will matter more, not less, a decade from now. When you see that kind of buying persist through both rallies and corrections, it tells you the demand isn't tourists, it's structural. Let's talk about the dollar itself, because currency strength and precious metals move in a relationship that's almost though not perfectly inverse. Gold is priced globally in dollars. So when the dollar strengthens against a basket of other currencies, gold often becomes more expensive for foreign buyers, which tends to soften demand and pressure the price. When the dollar weakens, the opposite tends to happen. Through the middle of 2026, the dollar found some support from America's position as a major energy exporter, which insulated it somewhat from the inflationary pressure of Middle East tensions that were hitting oil importing economies far harder. But currency strength built on a temporary energy advantage is a different thing entirely from currency strength built on sound long-term fiscal footing. And that distinction matters enormously if you're trying to think several years out rather than several weeks out. Which brings me to geopolitics, because I don't think you can separate monetary policy from the geopolitical backdrop it's operating within right now. Tensions in the Middle East, disruptions around a critical shipping corridor for global oil and gas, and a temporary but fragile peace arrangement between the United States and Iran have all added a layer of energy-driven inflation risk on top of an already complicated domestic picture. Here's the important nuance. Not every geopolitical shock helps gold. When conflict drives oil prices sharply higher, it can actually work against gold in the short term because rising energy costs feed inflation fears, which feed rate hike expectations, which raise real yields, which pressures gold downward. Even while the same headline is on its face exactly the kind of crisis story that intuitively sounds bullish for a safe haven asset. This is one of the most misunderstood mechanics in the entire precious metals market, and it trips up a huge number of newer investors who assume any bad geopolitical news should automatically be good for gold. It isn't always. The transmission mechanism matters more than the headline. I want to pause here and talk about something that has nothing to do with spreadsheets and everything to do with why smart people make bad decisions with their money. There's a reason fear and greed dominate financial markets more than any spreadsheet ever will, and it has to do with how our brains are actually built. The amygdala, the part of your brain responsible for processing threat, doesn't distinguish particularly well between a genuine physical danger and the sight of your portfolio dropping 4% in a day. It fires the same stress response either way. A flood of cortisol, a narrowing of attention, an urge to act immediately rather than think carefully. That's precisely why so many investors sell at the bottom of a correction and buy back in near the top of a rally. It isn't stupidity, it's biology, operating exactly as evolution designed it to operate in a world of physical predators, misapplied to a world of price charts. On the other side sits dopamine, the neurochemical driver behind greed, which floods your system during a rally and creates a genuine, physiologically real craving for more exposure right when prices are already stretched. Understanding this doesn't make you immune to it. Nobody is fully immune to it. But understanding it gives you a fighting chance to recognize the feeling for what it is in the moment rather than mistaking it for sound judgment. Let me tell you about someone I'll call Daniel Reyes. 44 years old, a small business owner who I've made up to illustrate a pattern I've seen play out in real life more times than I can count. Daniel had watched gold climb toward an all-time high near the start of 2026, and by the time he finally decided to buy, prices were near their peak, driven as much by momentum and headlines as by underlying fundamentals. When gold corrected sharply over the following months, down more than a quarter from that high, Daniel panicked and sold near the bottom, converting a paper loss into a real one. 6 weeks later, when the metal began stabilizing on renewed central bank buying and shifting rate expectations, he watched from the sidelines as the price he'd sold at became a level the market never revisited. Daniel's mistake wasn't believing in gold. It was buying on emotion at the peak of a euphoric run and selling on emotion at the trough of a fearful one. The single most common and most costly pattern in all of investing, repeated across every asset class, every generation, every market cycle in recorded history. Now let me tell you about someone very different. A woman I'll call Priya Noor 61, approaching retirement, who I'm also presenting to you as a fictional composite built from patterns I've observed. Priya didn't try to time the top or the bottom of anything. Years earlier, she decided that 10% of her retirement savings would sit in physical gold and silver, not as a speculative trade, but as a form of portfolio insurance against exactly the kind of monetary uncertainty we've been discussing today. She rebalanced once a year, added modestly during corrections, trimmed modestly during euphoric spikes, and otherwise ignored the daily noise entirely. When gold fell sharply in mid-2026, her allocation dropped in value too. But because it was a small, deliberate slice of a much larger and diversified plan, the decline didn't threaten her retirement timeline or her sleep. Her outcome wasn't dramatic, it was durable. And durable, in my experience, beats dramatic in almost every case that actually matters over a multi-dead horizon. And a third story briefly, because I think the contrast matters. A young investor I'll call Marcus Webb, 26, discovered silver through social media during a period of rapid short-term price swings, and he leveraged his position heavily, borrowing against his exposure to amplify his returns. When silver dropped more than half from its earlier peak within a matter of months, a decline driven partly by genuine rate expectations and partly by structural mechanics in the futures market around monthly options expiration that have nothing to do with the metal's long-term fundamentals. Marcus was forced to liquidate at the worst possible moment because his leverage made the position unsustainable. He wasn't wrong about the long-term thesis. He was wrong about the structure he used to express it. Leverage doesn't just amplify your returns. It amplifies your timeline's vulnerability to exactly the kind of short-term volatility that silver, more than almost any other major asset, is known for. Before I bring all of this together, I want to ask you for two things. And I promise this connects directly to what comes next. If you found this kind of grounded, evidence-based breakdown useful, take a moment to like this video and subscribe if you haven't already, because I cover these shifts as they develop, not after the fact. And I genuinely encourage you to stay with me through to the end, because the final insight I want to leave you with only makes sense once you've absorbed everything we've walked through so far. The Fed's new communication philosophy, the real yield mechanism, the debt burden, the central bank buying trend, and the psychology that trips up even experienced investors. Each piece on its own tells you something. Together, they tell you something far more important. So let's walk through where things actually stand. As of the moment I'm recording this, Kevin Walsh has fundamentally altered how the Federal Reserve communicates with markets, replacing detailed forward guidance with what he calls a data-dependent approach, guided by what he has described as an unambiguous commitment to price stability. The committee he leads is nearly evenly split on whether further rate hikes are coming this year. Inflation forecasts have been revised upward. Growth forecasts have been revised downward. That combination, stickier inflation alongside softer growth, is precisely the environment economists refer to as stagflationary pressure. And it is historically one of the most difficult environments for a central bank to navigate cleanly, because the tools that fight inflation tend to slow growth further, and the tools that support growth tend to let inflation run hotter. Meanwhile, the federal government continues financing a debt load approaching $40 trillion, a burden that grows more expensive to service with every basis point the Fed adds. Central banks abroad continue accumulating gold at a historic pace, a decision made by professional reserve managers thinking in years and decades, not days and weeks. And gold itself, despite a sharp correction from its January highs, has continued to hold what analysts describe as a structural bid, meaning that even during its weakest quarter in over a decade, it never fully surrendered the gains built up over the preceding several years. Here's the single most important takeaway I want you to leave with today. And I want to state it carefully because I am not in the business of making predictions dressed up as certainties.